people to danger number one, and that is that the mainstream media and the mainstream financial world will never tell you there's a financial crash coming until it's too late. You think back of the dot-com bubble before that, or even the crash of 2009, or the savings and loan crisis during the 80s and 90s, and it's the exact same thing. You didn't know that Bear Stearns or Lehman Brothers or whatever was going to be bailed out until afterwards, which means that everything had collapsed, and you were out of luck at that particular point. That's danger number one. And if you go into Google Video, some of you may know economist Peter Schiff, and if you go into Google Videos and you type in "Peter Schiff was right," he's the author of the book Crash Proof, you will find him literally talking to hundreds of these people on radio and on television and on CNBC and BNN and all these shows, and he was sitting there telling them that there's a subprime mortgage meltdown going to happen, there's a crash going to happen, and everybody was telling him, you're an idiot, you're a fool, there's nothing going on, you don't know what you're talking about, and of course it all happened. And you can go on. There's lots of alternative people in the media, everyone from Robert Kiyosaki, David Morgan, Michael Maloney, who's I'm a big fan of, Max Kaiser, Gerald Celente, Catherine Austin-Fitz, James Turk, Eric Sprott, Mark Faber. All these people were telling everyone, shouting at the top of the lungs, there's a financial crash coming, and the mainstream media just ignored it. And so this is a fact. I don't know. I'm not trying to be mean or anything. I'm just saying that that's one of the things to be aware of. The reason I bring that up is that after the crash that happened and the S&P hit 666 in 2009, it bounced up. The markets all bounced up, and if you look at technical analysis, you can see on a chart that as the markets were going up, it was starting to lose its steam, what the dead cat bounce does. Let me explain what a dead cat bounce is to the audience for those who don't know. If you take a live cat and I know this might sound sick, but this is where it comes from. If you take a live cat and you throw it off a building, the cat is going to bounce and go up in the air, even though it's dead, and then it'll continue to fall and collapse. Well, that's what a market bounce is. So what happened was in 2009, the markets bounced from 666, and it bounced up, and it was going to continue its crash like it did in the dot-com and the financial crash of 2009, but the government stepped in, and they started printing QE. So what happened was QE started, and the bounce kept on going up, and it didn't crash. And then it was about to fall down again, and then they started QE2. And then it was going to start again, and then they started QE3. Now QE3 is now ended, and it ended, Janet Yellen ended it, right as they actually hit the bottom of the market correction, so now the markets are all going up. But I'm really concerned about whether or not there's enough real money out there to actually sustain the economy. We'll find out. Maybe yes, maybe no. But that's danger number one.
Danger one. And so QE, to the listeners out there, I know I had to learn about it, and I'm still learning, is quantitative easing, correct?
Correct. They're just basically printing money. That's all it comes down to.
Printing money from nowhere.
It's a fancy way of printing money from out of nowhere. That's pretty well it is.
It's just the printing presses keep going. And everybody doesn't know where it's coming from. They just want more and more, or whatever. Or some people don't realize. So really need to listen in, listeners. I know my libertarian friends out there know about it. And you mentioned Peter Schiff. He is amazing. And there are a lot of people who also respect Ron Paul because he predicted the housing bubble way back. When was it? 2002?
That would be about right. That sounds about right.
Yeah.
I've been a follower. It's funny. I've been a follower of Ron Paul for a very, very long time, as a lot of people are, because Ron Paul is an Austrian economist. I don't cater to any type of economist type, but I do kind of follow more Austrian economists than I do any other type, whether it be Keynesians or the Chicago School of Economics. And I know very well that Ron is really camped in the Austrian school, and so I've always listened to what he had to say over all these years. And it's nice to know that there's a lot of people out there that are now listening to him now that he's retired.
Well, yeah, because and he is an economic genius too. He predicted so much, and they do. They listen to him definitely on his money policies, and he's on a lot of the market shows. But I didn't mean to interrupt. We were going to go into. You talked about danger one, the quantitative easing, but Roy's holding his hand. But I want to make sure we get through all of these dangers so we could get to what works.
Okay.
Can I ask my question, Laura?
Yeah.
sure.
Okay. Leslie, as a real estate broker and a real estate company owner, we never really anticipated to be that market crash as bad as it was. We're still living through the repercussions of that with all the foreclosures we continue to handle on a daily basis. Do you think now, with the price of real estate as low as it is, that it's a good investment for the people who are listening out there?
I don't give advice in regards to the prices of the houses right now. What I would do is tell people is if we get to when we get to solutions in regards to what still works, I'm going to talk about, if we have time, how to pay off your home in half the time or less.
Okay.
And it might be very contrarian to what other people will tell you. What matters is protecting the value of the home, not the price of the home.
Mm-hmm.
And we will talk about that. If you follow markets, yeah, now would be a good time. Like, especially with the deals, when I go online on your website and I see what's out there for sales, there are some bargains out there.
There sure are.
There are.
They're half
amazing
price.
bargains out there.
I mean,
Yeah.
really, realistically, they
Okay.
were around 50 cents on the dollar.
Book the ticket, Leslie. You're here in the United States. It's not too far,
Well,
Boston.
For the first time in about 5 years, we've actually watched the price of real estate go up from 2013 to 2014, and it's gone up somewhere around 8% from what I can see, doing all the evaluations I do, and that to me is a good sign.
It's a good sign. I think it's a good sign that with the amount of money that the United States government, or the Federal Reserve, pardon me, has pumped into the economy, like, what is it, $3.2 trillion or something like that, that's a lot of base money. And a lot of that base money was meant to prop up the market because all of us that create money when we go and deposit our money and we take out mortgages and car loans and all that sort of stuff, we're literally creating money out of thin air. What happened was, in 2008, we stopped doing that. The banks tightened up their lending regulations, and we started saving our money. And when that happens, you can actually collapse an economy. So what happens is that they printed all this money up, and what I'm hoping is that there's enough of quantitative easing money out there that's sloshing around, that's actually moving. The velocity of money is actually moving. It's yet to be seen if that's going to happen. I am a little bit skeptical in regards to whether or not we have, the real market, the people like you and I out there, and the normal everyday middle class families out there. If we're actually, buying houses, buying cars, spending money, are we actually doing that enough to actually stimulate this economy and keep it stimulated? We'll find out. Now that QE3 has ended, we're going to find out whether or not that's a fact or not.
Okay, so are we going into the next one? We have 15 minutes left, so let's get to the important
All right,
ones.
here we go. And I'll get back to Ron Paul in a bit, too.
All
Danger
right.
number 2. Some financial advisors and institutions will stall, or they will not allow you to withdraw your money without a fight before and after a substantial market slide. I usually tell a lot of stories in regards to things that happened during financial crash of 2008 where people would stall. I had one client at that time who knew the crash was coming because we told her the crash was coming. She was trying to pull her money out before the crash happened. Here, Lorraine, you do this. Ask me for your money back.
I want all my money back.
Why do you want to do that?
I don't want my money back.
Why do you want to take your money out? Why do you want to take your money out? The markets are doing fine. This is the index chart.
Oh, I don't want my
up and
money.
up and up.
Actually, you guys gave me money, so.
Here's what I'm getting at. The moment you start...
Hey, ask him the question, Lorraine.
Okay, I'm asking.
I'd like to get my money
I
back.
want my money back.
Why do you want your money back?
Well, you think the market's going to crash?
Oh, you're being silly. The market's going to be fine. Markets go up and down. There's lots of turmoil, but the index always tell you that they're going up. Now, imagine having that conversation every single time you want to ask for your money back.
How do people live with themselves if they give
Well, a lot of people live with themselves because they believe they're correct. That's what it comes down to. So, if during danger number 2, there's going to be a fight. I've seen this with banks too, where people have switched over their banks to home equity line of credit, and all the lawyers have signed the papers and everything's done. And banks that were suffering with liquidity issues, they were stalling with their clients and giving their money back. And that's just another example. I could tell you other ones, but I'll move on to danger number 3. Danger number 3, many financial advisors will tell you that full diversification means investing in different sectors of the stock and the bond market, otherwise known as equity and debt. Well, that's not really true because, and by the way, I'm not against people investing in these sorts of things, whatever it is. Basic metals, capital goods, communications, consumer goods, energy, financial, healthcare, technology, transportation, whatever it is in the market, whether it's debt or equity, that's fine. But remember this, it's not full diversification. If I put all my money involved in Trent Realty, for example, if I invested every single dime I had with Graham Theodore to go and buy Trent Realty because it was market-related, whatever, that would have been a mistake. Obviously, I haven't done that. Neither have you guys. But what happens if the value of your currency is diminishing? So, what happens if you're losing to real estate or to gold or to silver or to water or land or something like that? You need to take care of all aspects of the market when it comes down to diversification. Danger number 4. This is probably the more controversial one, but it's true.
Yeah. And also, I got an email from Theodore. He said, ask Leslie to wax about central banking if you haven't already. So I just wanted to throw that out there. But let's continue with the
I'll get to that later. Okay. And hi, Theo. Danger number 4. Many competing financial advisors will tell you that the other group is either wrong, misguided, scammers, even if they are not and their investment products are better. I have seen this so many times where back when I was a financial advisor, when I was able to operate in what was called the exempt market world, security world, I don't know how many times I would listen to the market-related guys tell the non-market-related guys that their products are dangerous, and the non-market-related guys would tell the market-related guys that your products are non-performing. You've had 2 crashes in 2000 in the millennium, .com and 2008, of course. Or you'd listen to a real estate investor, or you listen to a lawyer or a banker or an insurance advisor. All these guys disagree. One group will tell you whole life is terrible. The other group will tell you whole life is good. You need to go pick up term and buy the difference. They all disagree. And that's a problem when we're trying to look for answers. So to be fair, I always look at some of these things. Like, say, for example, cash flow real estate. I know in 2008, I've looked. You can't even lie to me. If you're involved in the real estate market, I probably know, and even if you're one of the financial gurus, you're broke. You have no cash. I've looked at everybody. They had no cash because they keep on buying doors and doors and doors, and they're financially strapped. But what happened was in 2008, not only were they financially strapped, they had upside-down mortgages at that time, too. Some of them probably still do.
I tell you, that was something that one day, hopefully I can get together with you guys and write a book, because I was screaming. Everybody thought I was nuts because I saw the prices plunge 30% in no time, and that was something with the bubble. And we have about 10 minutes left, so let's go through the rest, because I know we have listeners, because I'm getting feedback on my email right now.
All right, mutual funds. I'll go really quickly. Mutual funds. Talking about scammers and stuff like that. Sorry, not scammers, but in regards to danger number 4 about everyone disagrees with everybody. Let's remember this: 80% of all mutual funds can't outpace the market. You might as well just go grab yourself a cheap stock account and go buy the index. Mm-hmm. Why even bother with the MER fees and stuff like that? Bond market. There's a bond market. A bond market is based on risk. So, say for example, Canada's bonds. They're the safest bonds probably in the world. That's arguably, so please don't debate me on that, because I'll cry uncle. But, say, for example, it's 1% a year. Well, you've just lost your money to both taxes and inflation. Mm-hmm. But, say, for example, Greece. Greece at the time, which I think they finally, as of this week, have pulled themselves out of the recession, and they're moving upward after all the damage that's been created. But their bonds were at, ridiculous amounts of prices. They were at 140% or something like that. Clearly, they're going to collapse, and so there's risks involved with that. The last one I always talk about in this regard is the private equity market, which is the market I was involved with. Mm-hmm. I can tell you scam after scam or problem after problem with the private equity market. Clearly, I'm part of the private equity market because we've bought in you guys. So there are success stories, but there's a lot more. There's also a lot of dangers involved with getting involved in the private equity market, and most of the times it comes down to management. Management is either made a mistake or have been dishonest. That's what I've come across in my time. Danger number 5. This is where I get into Ron Paul world. This will be a good laugh to some people.